Sure. Thanks very much. Maybe to start with, it's a pleasure. It's an honor to be part of this forum. As some of you may be aware, FinIQ is quite a recent entrant to India, although we have been around in India for 21 years now. The company was initially set up in Singapore, but the development and the R&D team has always been based in India. We have close to 400 people in Pune mainly, and some in Nasik as well. So we've always felt that we were missing something by the fact that we did not have a presence in India. So we tried to correct that by opening up our Mumbai office in July this year. We just also opened our Bangalore office. This is probably the first time we are trying to speak to a lot of you in this kind of a forum, which will hopefully give you a bit of an idea as to what we do and what we are trying to achieve. Now, I'm going to try and share my screen, and maybe you can just let me know once you're able to see it. Just a second.
Yes, Sandeep, we can see your screen now.
Yeah. Okay, that's
yes,
great.
it is visible.
Right. So as Fora mentioned, I'm just going to spend about maybe about 35 minutes roughly. I'll keep a watch here so I don't go over time too much. And I will talk a little bit about the digital evolution of structured products, and specifically in the Indian context. Now, just to provide a little more of background to myself, as was already mentioned, I spent 29 years with Citi. The first 9 years of those were in India, and then I was transferred to London, and I spent the next 20 years in London until I finally felt that I had had enough of banking back in 2019 and came on board with FinIQ, as well as a couple of other advisory positions. I spent a good part of that time in structured products. So I had a very good feel of the way it evolved in the Indian context. So we're going to talk a little bit in the international context rather. So we'll talk a little bit about that, talk about why these products are becoming more popular, and they are very, very popular at this point of time globally. We'll spend some time on the current status of the structured products market in India, and also specifically some of the regulations and pain points which have probably been preventing the real growth in structured products in India at this point of time. But we see that changing very quickly, and we see that changing quite rapidly now. I think we are already starting to see some of that evolution starting to happen. And a large part of that evolution, in our view, has been driven by the fact that there's been a tremendous amount of digitization in this context. And that's really what we are going to focus on, because that's really where FinIQ comes into the picture. So let's spend a few minutes on the capital markets journey, and specifically around the whole digitization aspect. And this is just going back to my own history. 1990 is when I joined the industry, joining Citibank in Mumbai in 1990. So at that time, our operations in foreign exchange and fixed income and pretty much any aspect of capital markets was almost entirely manual. There was an army of traders and brokers who were providing us with liquidity across multiple products. Processes were entirely paper-based. Dealing was always on voice, so we had to be on a phone call to close a deal. And primarily, it was vanilla products. And again, it was not very different in the rest of the world. I think India was pretty much on par. Through the decade between 1990 and 2000, I think we started to see certain levels of automation, but we still had pricing entirely controlled by traders. And we started seeing the advent of structured products, mainly around the time when we had, some of you would remember the crisis around the dot-com bust. So a lot of people in the international markets essentially figured out that they were losing a lot of money from there and wanted some level of capital protection. And that was the initial period of structured products. And at that time, structured products were mainly centered around some of the key themes in terms of investing in certain markets, investing in certain, let's say, underlying oil or commodities or FX. But as we started progressing between 2000 and 2008, really, this period, we saw an excessive amount of complexity coming into those structured products. And those complex products quite often became black boxes in the sense that nobody really knew what was going on behind. You were just betting on the fact that somebody would come up with a pretty, clever way of beating the markets. And so you had things like the CDO squared and all those credit derivatives coming into the picture, which were also some form of structured products, which ultimately led to the global financial crisis. As many of you, and I won't go into the details of what happened there, because I'm sure all of you would be pretty much aware of the whole subprime crisis and how those products led to most of the banks going into a huge amount of problems. But what that meant when that crisis happened, that also resulted in an intense amount of regulatory scrutiny around the entire structured products market. Well, not just structured products, it was there pretty much across all of banking. But I think part of that regulatory scrutiny also meant that there was a huge advance in electronic trading. And this is not just structured products, but across FX, for example. A bulk of the pricing started moving into what is called auto trader. And again, some of you would be aware of some of the scandals in the FX market, which partly led to more of robots being responsible for pricing. And I think between 2010 and 2020, we saw in many of the banks, including in Citi where I was working, a lot of the pricing being, or a lot of the traders who were responsible for pricing being replaced by robots. And there was electronic dealing across pretty much all sectors of the capital markets. Also, there was a multi-bank revolution whereby through the process of digitization, banks or end customers were able to access much better pricing. So there was better execution. There was a focus on best execution from some of the regulators, and that was again led by the digital revolution around this particular market. And in the process, there were multiple attempts to create end-to-end automation, particularly around structured products, which also led to a situation where there was the ability globally to increasingly personalize and customize these products. So if we think about what happened globally, we can talk about how the fintech revolution at the same time was causing a certain amount of transformation in the capital market space. And this is where Finaccio as a company was intimately involved in this entire process of transformation, while when trading platforms were starting to replace the traders and dealers who had been responsible earlier for providing prices both internally to the salespeople and for then the salespeople to then provide those prices to external counterparties. That entire process started getting replaced from being voice-driven to more electronic. And this was not just for traditional shares, bonds, funds, FX products. This was something which was starting to happen across many of the exotic products. And increasingly, that led to more of an over-the-counter kind of derivative trading facility whereby any kind of product could, or any kind of options could be dealt between one counterparty versus another through electronic means by the fact that now there was much more connectivity. And also this distribution ability to reach retail investors became a very important part of the growth of the structured products market globally, with multi-bank pricing in turn allowing for more competitive pricing. And this was very important even to the regulators, because they found that so long as a single bank was making a price to a single investor, there was always the possibility of a very, very large margin being maintained, because these products were priced on the basis of multiple volatility and correlation parameters, which meant that between one bank to another, there could be a very, very significant difference in pricing. So as you started getting more multi-bank pricing through electronic means, it meant that the end customer was getting far more competitive prices. And that also provided a certain level of comfort to the regulators to allow this market to proliferate a lot more. So essentially, if you think about the fintech world, it started off, and to some extent, it is still associated with payments. So payments is by far the largest part of the fintech revolution. I think in India and elsewhere as well, the credit tech became a very important part of this. And more recently, the wealth tech part has become a very key aspect of the fintech revolution. And I think we see the future of the whole wealth tech piece, and specifically around structured products, being around the digitization of creation and distribution of structured products. So it's not just the ability to price the product, it's the ability to then be able to look at multiple alternatives to create the right kind of product in line with, let's say, the existing market conditions, and then be able to efficiently distribute those products. And that is where we believe will be the biggest transformation of this particular sector in the Indian markets. So let's talk a little bit about how the global structured products have evolved over the last two decades. And this, I'm just going to talk briefly about our experience from a city perspective, which I think was largely reflected across most of the other banks, and to some extent, also reflected in the Indian context. So if we look at, as I already mentioned, early 2000, it was after the dot-com bust that we really saw a huge amount of interest in capital protection. So people wanted exposure to the markets, but did not want to put their capital at risk. So in the initial days, there was a certain amount of participation that you could get in an index, or maybe in a basket of stocks, or maybe an individual stock, with the proviso that at maturity you always got your capital back. Now, this was at the initial stage. Increasingly, the products, as I already mentioned earlier, got more and more complex, and there were a lot of these black box kind of products. Some of you might remember the term called constant proportional portfolio insurance, and that those CPPI structures meant that the underlying asset into which the money was supposed to be invested could be managed dynamically based on the level of interest rates and based on the NAV of the underlying assets. And but that again meant that the final payoff or the final return that a client would get would be purely based on a black box, which nobody really understood. And some of that created all the problems that started happening, which then led to the global financial crisis. Now, after the crisis, and again, I'll make a distinction between what happened globally and what happened in India. So let me talk initially about what happened globally. After the crisis, initially, there was a tremendous amount of focus on compliance. And again, a part of this was driven by the fact by a particular incident that some of you might remember, which was the collapse of Lehman Brothers in, I think it was 15th of September, 2008. And like many other people in the global markets in London, it was just complete panic because Lehman Brothers had become by far the largest issuer of structured products. Now, again, when I say issuer, they were essentially providing the balance sheet. So they were the ones taking in the funds. So the capital protection on these products was guaranteed by Lehman Brothers, while the underlying structure might have been created by Citi, by JP Morgan, by SocGen, by any other bank. But they were sold to customers of Citi, JPM, and SocGen, the issuer being Lehman Brothers. So when Lehman Brothers collapsed, it obviously meant that all the people who had invested in these products suddenly found that their capital protection was non-existent, and they were facing 100% capital loss. And many of them had not understood that their capital was exposed to the risk of Lehman Brothers. They thought they were getting a product from Citi, they thought they were getting a product from JP Morgan, but the actual capital protection was based on Lehman Brothers. And this then led to a massive fallout where regulators got involved, compliance people within the banks got involved in terms of the level of disclosure that had been provided, or the level of education that had been provided, not just to the end customers, but even to the relationship managers who had sold these products, was found to be inadequate. And so there was a clampdown. A lot of the regulators in multiple countries came and asked for a massively transformed process through which this information could be conveyed to all aspects of the system. So whether it was the creation of the product, whether it was the pricing of the products, or whether it was the communication of the information of the product, that needed to be far more stringent, and far more details need to be provided in terms of scenario analysis, what if analysis, backtesting analysis. All of that required to be provided as part of something called the key information document, which became a very important part of the structured product process in Europe in particular. And as a result, most of the banks who were offering these products realized that without having significant automation and significant digitization of the entire product, process, they could not really manage many of these products. So initially, I think in the first 4 or 5 years after the financial crisis, it became incredibly difficult for a lot of banks to actually be able to sell these products. But then on account of the extent of digitization, which I think I'm glad to say FinIQ was a very, very important component of, the market started becoming much more efficient in many ways. And there's something that we are proud to say that FinIQ is now the world's largest platform for structured products. We're probably going to do about 75 billion this year. We did a bulk of that is in Asia, which is the largest market for structured products. But we also have a significant footprint in Europe and now looking to expand into US and LATAM as well. And this has largely been driven by the extent of digitization that we have been able to provide to about 45 different banks who are our clients across the world. So that really is what we are trying to now bring in to the markets in India. And if we think about what the markets in India are like, again, the information that we have on the slide is somewhat limited. I think from full year 14 onwards, we have some numbers. But as you can see from there, there's been steady growth. But just in the last 2 years, or full year 18 versus full year 20, we've seen a doubling of the volume. So that itself tells us that there is significant growth. But if we put this in a global context, and I think it's very important to put it in a global context, there is information from Bloomberg which showed that as of 2nd March 2021, there was over $7 trillion of invested assets in structured products. Relative to that, the total volume of structured products was about 2 billion. Now, the 7 trillion translates to roughly, maybe, depending on which publication or which article you look at, somewhere between 5 and 10% of all invested assets globally are in structured products. Relative to that in India, that figure is less than 0.5%. So that in itself tells you that there is a significant growth prospect, because I think some of the digitization benefits and some of the disclosures and the transparency that came into structured products is starting to happen in India. And we very much would like to be part of that process. But there's still obviously quite a significant number of pain points in India, which make it difficult for the structured products to grow to the extent that it should. And let's talk a little bit about the pain points and how that is something that we potentially will be looking to change. So let's look at product manufacturers first. I think there is a lot of complexity in customizing products. At the moment, products are typically created based on certain market views and sold to multiple investors. And part of the problem is that, there is a regulatory framework, which I won't go too much into, but I think the liquidity is a very, very clear reason why it is difficult to create the right kind of product for the product managers. And if you do not have liquidity, then obviously there is a need to manage the risk on your own books, which again has certain complications. The risk management process itself was always a little bit, well, I would say it was missing, but it was not as stringent or not as effective as it is in many other parts of the world, which is a bit strange because, just going back to my own experience, having worked in Citi and having interacted with banks all over the world, a large number of the risk managers and a large number of the structurers are actually from India. So it just begs the question as to why we aren't having a much better risk management kind of framework in India. But that's, again, something that I think is starting to happen. And the ongoing compliance, I think, whether it's regulators, whether it's the SEBI, RBI, they have to feel comfortable about the risk management process of the banks or wealth managers or anyone else creating and distributing these products. Compliance in terms of disclosures is another aspect. So all of that, which started happening, kind of just after the global financial crisis, I think has just about started to happen in India as well. Now, if you talk about the distributors and the brokers who are involved in this particular market, I think the analytics is a very important part of what led to much higher levels of comfort with these products globally. And when I talk about analytics, I'm talking about scenario analysis, backtesting analysis, what-if analytics, looking at multiple parameters, trying to figure out how a product would perform in different kinds of environments. Now, that process of being able to do this does require quite a considerable amount of capacity to simulate different market conditions, capacity to then take multiple prices from multiple providers if required, to be able to then have some good analytics as to what could happen to certain products. And that, again, is something that FinIQ was very much involved in providing, and that's something that we'll discuss briefly as well. But it's something which has been missing in the Indian context. Order execution management, order and execution management. So the ability to manage orders electronically, to execute electronically, was not really there. And again, something which was a pain point for a lot of people. Restrictive distribution. So if you do not have the right electronic platforms to be able to distribute, that meant that given all the other regulations and the need for transparency, it was difficult to distribute these products. For relationship managers, and for that matter, IFAs and other intermediaries within the Indian context who need to distribute these products, I think there has been, ever since the crisis and maybe even before, a lack of confidence to market these products given the complexity of the products. And there is obviously a hangover from what happened in the financial crisis, where there was a clampdown on a lot of these products, partly because of the complexity. And when you have incomplete information being disseminated to clients, that is always going to mean that there are going to be regulatory problems or compliance problems going forward. For the investors themselves, I think the complexity of the products was also a bit of a turnoff. For that matter, if I look at the global context as well, a lot of investors felt that prior to 2008, they were getting a lot of products where they wanted capital protection. And frankly, that's all they ended up getting. They just got their capital back because they never really understood how the dynamic management of the underlying assets would finally lead to a certain better return. So there was a promise of a much better return, which never materialized. So the complexity of the products was always a problem, but that is something that has changed dramatically over the last few years in the global context. And we'll again talk about that briefly, but that continues to be, I think, a little bit of a stumbling block in India. Lack of clarity regarding the risk involved is related to the same complexity. Lack of complete transparency in terms of what would be the return in certain market conditions. Again, not very, very clearly conveyed and not very clearly understood, and that is part of the problem. And I think lack of secondary market liquidity. So most of these products, and this is, by the way, not necessarily an Indian problem, it is there globally as well. And it continues to be a problem globally, whereby it is a little bit partly to do with the way the banks have managed it. They are not necessarily very keen to see huge amount of secondary market liquidity for these products, because they feel that the market has become very competitive, especially now that you have multi-bank pricing and much better electronic platforms through which you can deal these structured products. So part of their objective is to try and generate better returns by the fact that some market players or some investors will come back for divesting these products in the secondary market. And that's when these banks can charge a much better spread. But that said, FinIQ is involved at the moment in multiple initiatives to create secondary market liquidity for a lot of these products. And that, again, is something that we can easily bring to an Indian context as well. So let's then talk briefly about what it is from an electronic, let's say, delivery or a digitization perspective that we see as major game changers in this market, and how technology has been used and can be used, again, in an Indian context to address some of these pain points. So let's talk initially, and we're just going to show you a few brief slides of our platform, which all of you are welcome to come and have a conversation at a later stage with our team in India if you want to see this in more detail. But the whole objective of the platform is for product teams. And again, as I said, we have multiple clients all over the world who are using this platform. They are able to create and simulate various kinds of structures. And what you can see on the screen there is one where they are able to actually use, this is a product which we call an autocall multi-pricer. Now, the autocall is essentially a product which is linked to equities where there's a possibility of getting a certain amount of return, again, a very, very transparent return, but also the possibility that in the event that the market goes above a certain point or hits a certain trigger, the product automatically gets called before maturity, which is attractive for both the investor as well as the bank selling the product, because then they have the chance for the client to reinvest in something else. So what this kind of a screen provides is the ability to try out various different combinations, maybe of the underlying stocks that you could use or the underlying indexes or indices, and create the most appropriate product, which can then be sold. So the product team can then analyze this product to choose the right one. And this includes analysis, not just of maybe trying out multiple baskets to find the one which provides the best possible optimum kind of returns based on the risk involved, but also to be able to then backtest the structure, provide all kinds of forward-looking what-if simulations using multiple ways to, let's call it, predict or forecast what could happen in the markets in the future. And do this not just for internal comfort, but also to provide this level of information and transparency to the end client where required. And this, again, has become a very, very important part of the evolution of these products, that from a situation prior to the financial crisis, where these products were just sold on the basis of a promise, today they are being sold on the basis of very detailed scenario analysis, very detailed what-if analysis, and an ongoing ability to provide this analysis through the life cycle of the product. So a product is not just starts on day one and finishes on, let's say, end of 3 years, but the relationship managers or the IFAs or anyone selling the product has the ability to actually monitor this performance of the product, to monitor the life cycle during the life cycle of the product, and provide a tremendous amount of transparency to the product. Also, whenever there is any kind of event, for example, there's a corporate action on a particular stock, there's a dividend payment, there is a tremendous amount of complexity involved in reworking the product parameters. And that, again, is something that a lot of people used to struggle with. And particularly in a situation where you have, just to use one example of one of our clients who has 1,500 of their relationship managers using the FinIQ system, they have multiple queries, they have multiple products available to their clients at any point of time. They need to be able to provide answers very quickly to their end clients. They need to provide analysis, so they are able to get that all at the click of a button from the FinIQ platform using screens like what you're seeing here. Going beyond that, let's assume we take it more in an Indian context. Now, globally, what has happened is that there is a lot of fine-tuning or customization of these products happening even for individual private clients. So a private client might come in and say they've got $1 million to invest in a particular view that they have. So they might say that they have a certain view that certain tech stocks are likely to do well, but will probably not go above a certain level in the next 1 year. And so they would like to get a guaranteed coupon of a certain amount and also have certain barriers. And maybe if the stocks fall below a certain level, they are happy to get delivery of the stocks at the reduced price. If you want to, kind of simulate that particular structure, create the structure for an individual client, and you have thousands of individual clients coming for those kind of requirements, then obviously it's very important to have a platform. But even if you don't, and I think the way the market will evolve in India is initially there will be, like there already is to some extent, the ability for a product team to create a product and then launch the product on a platform. And that launch period could be what we call a book building period over maybe a week or a few weeks, during which time the relationship managers or the IFAs or any other intermediaries involved in selling the product will go around trying to generate interest from their clients. And again, there can be certain definitions, certain parameters put in place for the minimum size, for the maximum size of the launch. And this entire process can be monitored online, because if you think about it, during the process of selling this product, markets are changing all the time. So it's very important for this risk to be managed efficiently and effectively. And that's what a product team is able to do through a platform. And then going one step beyond that, when it comes to the relationship managers or the IFAs, they may have not just one product that they are selling at any point of time. They might have a combination of 4, 5, 6 different products, which have been created by the product team. And the sales team can look at the catalog of products, create the required documents where required, or generate those proposals that might be required. Maybe it's part of a portfolio, and that portfolio could include all kinds of other products, which again, incidentally, people quite often use the FinIQ platform to do mutual funds and shares and bonds. And you want to find a structured product within that portfolio and sell the appropriate product with the appropriate proposal and the appropriate disclosures. That's all available electronically. And on top of that, I think the suitability checks, so the onboarding process of the client, which involves looking at what kind of risk a client is, when I say client, I'm talking about an end customer, is willing to take. So they might feel that they can live with a certain level of capital loss, but not beyond that. They might have certain kind of criteria, and that the process of actually managing that criteria in line with the risk parameters of a product. So managing the client profile of the profile of the customer with the profile of the product is a very, very important suitability check, which was almost mandated by the regulators in many of the countries that FinIQ operates in today. And creating the process to ensure that those suitability checks can be performed at the click of a button without a tremendously elongated process was a very critical part of the evolution of these products and the growth of these products again. Because for a while, as I mentioned, between say 2008 and 2013, 14, there was almost like a lockdown in terms of the ability to distribute these products because of the extensive amount of suitability checks and compliance requirements which had to be done manually. And it needed the electronic platform to come in to be able to facilitate that process. So ultimately, once the product is sold, I think it's also extremely important that the relationship managers, the financial advisors can then monitor the daily performance of the product, can communicate aspects of the product with their end customers, can actually do their own analysis at times. Again, we are not talking very, very complex products in the Indian context. We are probably going to start with relatively simple products, but some of these products could involve regular coupons. So you need to monitor the coupon, and you need to have an electronic ability to pay those coupons at the appropriate times. Those coupons themselves may start becoming contingent on the performance of the underlying index. So let's say it's the Nifty index. Having the ability to then do that electronically is also very important. And of course, communicating all this to the client and then being able to manage the client portfolio in an appropriate manner is a very, very important part of the whole digitization journey around these products. So really, this was just a very brief snapshot. So what we are very keen to do in an Indian context is really democratize this entire process. And here we are talking capital markets, but the focus obviously is in the area where FinIQ is now the global leader, which is structured products. So I think India has been at the forefront of the fintech innovation. We all know that. I think the smartest people, it was very, I think it's a proud moment for us to see the number of CEOs of all the top, international tech companies, which are who are from India. But for whatever reason, I think structured products have still been in their infancy in India, despite the fact that a large number of the structured product, let's say, evolution, creation is driven by Indians in many of the banks in many parts of the world. And that evolution of the overseas market, thanks to increasingly client-friendly structures, is something that we see beginning to happen in India as well. So our mission really is to bring home a large part of this global product expertise, which I think we have developed over 21 years. In fact, if we go back in history, in 2001, well, 20 years ago, when we created the first initial structured products, or we created a platform for something called dual currency deposits in Singapore. And dual currency deposits is nothing but a structured deposit with a link to an FX price. So there's an underlying option which is sold. And while it sounds simple, it was incredibly difficult to manage, to price, and to just disseminate or distribute across a lot of retail clients who are also using this product. So thankfully, thanks to that platform that was created in 2001, FinIQ was a very, very strange fintech company because it became profitable from year one and has become very cash rich since, which allows us then to invest in the Indian market and really create the right kind of platform by working with banks, with brokers, with regulators, with a lot of you hopefully in the audience today, to really look at the entire AIF framework, which from what I understand, what I'm told by my colleagues also, is the main framework within which the AIF and I guess the PMS framework within which structured products are going to be done in India. And we are very keen to work with all of you to ensure that we can actually do this the right way and really see the kind of product distribution, which we have seen in the global context. And again, globally, as I said, it was not like we were seeing massive volumes even 5 or 6 years ago. These volumes have increased dramatically. They were very large back in the early 2000s, but they have now gone even larger. And I think the difference today is that digitization has created far more transparency, far more ability for the end customer to understand the product, to feel comfortable with the product, for compliance to feel that the issuers or the creators of the product are providing the appropriate disclosures with the appropriate level of regulatory compliance. Because again, and I keep using this term compliance, it has probably become the largest unit in most of the banks in many parts of the world. And I was part of that process in Citi, where we found the compliance team had to be expanded dramatically, partly because of the fact that the regulators were asking for so much more compliance, and not just on structured products, it was across any kind of product that we distributed. But structured products was incredibly, let's say, in the spotlight, partly because of the amount of noise that had been created on structured products during the financial crisis. And I think it's, again, also very important that the regulators in particular, and also the teams within the banks, feel comfortable about the ability for a product team and for a risk management team to have the appropriate tools to be able to manage the risk around these products. And I think, again, this is, we already mentioned it as one of the pain points earlier. The regulators do not feel comfortable allowing banks to just go ahead and, for example, start having a very liquid OTC over-the-counter marketplace in India. Large part of that has to be on an exchange, and I think there are two reasons for that. One is the fact that by dealing these options on an exchange, you are able to manage the counterparty risk a lot better. But the other is, I think there is still a level of discomfort with the ability of many market players to appropriately manage the risk. And I think it is this digitization aspect which I think will provide a large part of that comfort. And digital access to liquidity across a wider range of products will be instrumental in many ways for this market to grow, for this market to feel comfortable with the idea that if you want to create a product, it's not going to be something where you have to manage all the risk in-house. It is something where you can actually lay off the risk appropriately at the click of a button with multiple market players. And again, this is something that we in FinIQ have done very successfully across the world. I'll show you in a minute the number of counterparties that we have, and they are kind of the who's who of the global financial marketplace. But in India, we are very keen to also work with all of you to see how we can create more of a marketplace. So one aspect is the whole digital ability to create, to risk manage, to distribute, and to lifecycle manage these products. The other part of it is to create a marketplace which will allow for much easier liquidity to be available for many of these products, because we know that for many of you in this audience, that represents a very key pain point. So just the last slide, I just wanted to provide a very, very broad kind of picture of the partnerships that we have across for equity structured products, for FX derivatives, for equity derivatives, for structured FX, cash FX, and also bond and shares. So FinIQ is a multi-asset, multi-product platform globally, now present in 13 countries and looking to expand further. India is going to be a very key part of that expansion plan. But if you look at just the names represented on some of these circles, you can see that pretty much every large bank in the world, every large financial institution is a client of ours in some form or the other. Increasingly today, we are starting to see more interest from wealth managers, from brokers globally who are interested in our platform, from external asset managers, for example, who are starting to get onto our platform because they see us as the primary source of liquidity on the products, as well as having the ability then to manage the execution, manage the risk, manage the life cycle of these products. So this is really what I wanted to say. I think I'm going to stop here. I also wanted to thank all of you for being part of this forum and for listening to me. And I will now open this up for any kind of questions.
Yeah. So thanks a lot for that, Sandeep. So there's a question from Rahul in the audience. His question is the platform live, and who are the current issuers and liquidity providers listed on your platform?
So in India, as I said, we have only really started this initiative in July this year. We have made a huge amount of progress in terms of connecting with multiple market players. We are in the process of going live with two players right now, one large bank as well as a large broker. So to answer your question, is it live? Not yet, but we are about to go live. We are hoping to do that before the end of December, so in this month itself. But obviously, what we want to do is then connect a whole host of players so that this then becomes something which is not just for the purpose of managing bond structured products or any other products or create an ecosystem for these products, but also then provides the access to liquidity, which I think will be critical.
Another question, since such structured products also entail credit risk from issuers, does your platform also provide credit analytics to the issuer and metrics related to default, probability, loss given default? I think this is more from the global context.
Yeah, so again, that's a very, very good question. We do have credit as part of the portfolio of products that we provide. Within that, there is a certain amount of risk analytics. I wouldn't say that we are right up there on par with the top. There are other providers who are probably more tuned into the credit aspect. But we do provide a certain amount of functionality around that, and we are more than happy to share that with whoever asked the question at a later date. But yes, the credit aspect is a very important part. What we do provide, and this I think is again more from the point of view of managing the credit risk on a lot of customers. For a lot of these banks tend to take leverage on these products, which means that they will invest in a structured product, but they will then use maybe certain bonds they are holding, maybe certain other products they're holding as collateral to borrow more money to then put a larger investment into a particular product. The ability to manage that risk, which really becomes a margining risk, is a very, very important part of the functionality that is available on the platform. So when it comes to managing or monitoring the risk on the end client, and that could be related to not just structured products, but also FX, fixed income, various other products, we do provide that ability. The ability to manage the, let's call it the counterparty risk in terms of if you have a certain limit with a particular counterparty. Let's say your liquidity providers in a global context are UBS, Natixis, and HSBC, and you have a certain risk limit against each one of them because you obviously do not want to be too exposed. You do not want to have a Lehman Brothers situation, for example. The ability to manage that risk with mark-to-markets of all the products that have been issued by that particular issuer against the limit that has been set in your own system, that ability or that functionality is very much part of the platform.
Okay, so we can open the floor to the audience. If anybody has any questions, any comments related to structured products, I think please feel free to unmute yourself and participate.
Okay, I ask one question then. So you
Yes,
mentioned that you are able to track the performance of the structured product, but for
Yes.
that you would need to be able to price it, I think. So how would you do that? I mean, do you get the market data yourself and have a model?
Excellent question. I think we have both models. So globally, what we do is we have all the models, Monte Carlo, various others, which are used to price the product. So some of our clients prefer to just use the FinIQ models for the purpose of actively monitoring the mark-to-market, or even monitoring, for example, the probability of a certain digital trigger being exceeded. But we also have the model which we have available now increasingly on the cloud, where a number of our counterparties are directly providing the mark-to-markets on a daily basis, which are then being made available to the end, to the buy side users, as we call it. So you have the sell side, who are the product providers, who are providing regular input, which is not necessarily real time. It's usually once a day mark to market, which then gets conveyed to any buyers of that particular product on our platform. And similarly with any kind of events, typically when there is like a corporate action event or any kind of a trigger event, the FinIQ system would be able to provide the initial analysis, which would then provide, let's say, an alert to a particular buy-side client that the event is going to be triggered. But if a trigger event has actually happened, that is always then substantiated and corroborated with the issuer of the product. That is part of the process which is available within FinIQ.
Okay, thanks.
Okay. Any other questions? Or since we have a bit of time, if you like, what we could do, Alok, if you feel comfortable, do you want to just give a little bit of an overview for the benefit of everyone here? And I'm sure some of this would be common knowledge to all of you, but for me also, it's a learning process in terms of how structured products operate in the Indian context. And I think we've done a lot of research, we've done a lot of analysis of this. So maybe specifically in the Indian context, how structured products work today. Alok, do you want to provide a quick 5-minute overview?
Sure. Thanks, Sandeep. Hi, Rahul. Yeah, we connect from our earlier days. So basically in India, what Rahul wanted to know, I think it's today structured product in India is largely MLD or market linked debentures, which are governed under Debt Securities Act. But globally, what Sandeep broadly highlighted, equity linked structured product has become pretty popular. And for Asian market, especially Forex linked structured product has become very popular. So when you, as an asset manager, do want to offer some complex equity linked product based on your view as a house or as a fund manager or as an asset manager to your client, and sometimes client also do have their particular view on the market. It could be a range bound, it could be directional with a certain limit, or could be range bound for a certain period. So this kind of views you can actually use to create a product. So that's the evolution has happened in last I'd say last 5 to 6 years globally, and that market has become pretty large. So as an asset manager, to this forum, I assume most of you would be either asset manager or investment manager, creating product for your set of client or creating product for your distribution channel, where you would love to hear how technology or digitization would help you to create right product based on the house view or based on the view from the client you do receive. Especially keeping your large HNI, ultra HNI family office client. That's the segment market is moving toward. Recently, SEBI has also approved the accredited investor concept in India, which will also give some bit of flexibility to your set of client or HNI client to have some flexibility in terms of the amount of investment, although the detailed clarity is yet to come. But we believe what has happened in other developed market, this is going to come in India, and technology is going to play a big role. At this moment, we wanted to create an ecosystem with both sides of the market participant. One is manufacturer of the product like alternate asset funds, and also other side, like we call it a buy side, they are wealth managers across, be it a boutique or large private. Globally, we have worked primarily with the banks in the major market, but for India, we are again exploring the market. Would be happy to interact with each one of you if you are interested, one-to-one or more of a close to private meeting. So to explore what would be the best fit for Indian context, and would be happy to connect.
Yeah, I think some people have shown interest in knowing more about the platform. If I could just request anybody else in the audience who wants to know more and would like to connect with us, they can leave their email ID on the chat box. We will reach out to you subsequent to the seminar, and we'll be happy to connect one-to-one and discuss. Yeah, Anand, do you have a question?
Yeah. Yes, Mr. Alok, just to want to understand, like when you say again structured products for again equity and debt, so like will it be a scenario like, as you know, equity and debt, they don't move together. So if there is a change in say like say US Fed rate, and then what could be the impact on a global equity market or Indian equity market, and similarly on a foreign exchange. So these kind of analytics are also available, because you are mentioning that this will be useful for a AUM or a mutual fund kind of a organization as well.
So yes,
maybe I can take part of that question. Alok, you can then elaborate further. Obviously, as a technology provider, we don't necessarily go around trying to forecast specific areas of what could happen in the market. And your point is absolutely valid. If US suddenly decides that inflation is a big concern, starts raising interest rates, then markets are likely to crash. You might see, the yield curve steepening. So there could be all kinds of things happening also with an impact on the Indian market. What we provide is the digital capability, or let's call it the technical capability, to be able to almost map out all those scenarios, right? So if there is a possibility that interest rates will go up and hence markets will go down, you can define that, okay, what happens if market goes down by 20% and interest rates, the yield curve steepens by a certain amount, what kind of impact will that have on a particular product? We can very much support that. If the question is, are we in terms of any kind of activity that we would provide or any kind of research that we would provide, obviously that's not our forte, but most banks use their own research groups to then use FinIQ to disseminate information about certain specific, let's call it, events in the market, or for that matter, any kind of outlook they might have. So most of our large banks, and I used BBVA as one of the primary examples, they've actually connected the research team onto FinIQ platform. So all the research in terms of what is likely to happen in the market is then fed into the platform, which in turn is then used by the product managers to create the appropriate product, which is then distributed to the relationship managers, who then can use those to distribute the product. I don't know if that answers your question, Anand, but this is very broadly a snapshot of what we are able to do.
Thank you so much. So it's usually said derivatives are something of a product of mass destruction. I'm sure your product will help to avoid those mass destructions.
Exactly. I think that's a very good way of putting it. Yeah, because, if you think back to 2008, it was mass destruction. I tell you, I was in the dealing room at a point when Lehman Brothers went down. Coincidentally, Citi stock also went down to $1 from $58 at that point. So there were, most people were under pure depression mode. But I was part of the structured products group, which had gone and sold a lot of products which were linked to Lehman Brothers. I can tell you, we did not feel as terrible as any other time in the previous part of the crisis as what happened that particular day, because we could see that there was complete destruction of value all around. And that's really what I think regulators, banks, compliance people, everybody wants to avoid.
But is there also a feed on the economic, indicators or, into your system?
So our system, again, based on what you need. See, we are connected to multiple data sources, like we are connected to Reuters, to Bloomberg. So we obviously do not create our own electronic feeds in terms of data. We take the data from Bloomberg, Reuters, or for that matter, there are other data sources which some of our clients are using and they subscribe to, and we provide the ability to take those feeds directly into the system, and where required, display it either to relationship managers or even to the end clients, where we are the engine behind creating, let's say, a client-facing platform. So the data feeds are not coming from us, they're coming from the data providers.
Okay, thank you.
Welcome. We have a couple more minutes. Any other questions? I'm sorry, Alok, did you want to add to that? Because I know you started saying something and I interrupted.
No, I think Sandeep, you have broadly covered. So just to give some perspective to the audience, some of you may be a product creator as an investment manager. Some of you would be purely wealth manager. So primarily this product is, or rather it's, we are a technology company. We create architecture for a large wealth outfit for creating the distribution of multi-asset single platform, or we create structured product platform for the manufacturer of the product to the distributor of it. So we connect both sides of the ecosystem globally, like all these banks Sandeep has mentioned. Some of them are product issuer, and some part like Bank of Singapore or UOB of the world, they are the distributor of those products. So I think Rahul has messaged me in private chat. So he is a wealth manager. So, but he is very keen to understand how this ecosystem would help to the asset manager, the wealth manager across this ecosystem. So we may create that ecosystem for the product creator or manufacturer to offer this kind of innovative product to the distribution fraternity, be it a large boutique or large banks, or maybe the IFA or RIAs across the country to distribute those kind of product. So the agenda or the endeavor is to create that ecosystem so that throughout the life cycle of the product, the risk involved into that risk side, be it linked to equity or be it linked to debt, are monitored, and so that the product creator can create a robust product for going forward. Today, in terms of the structured product, it's a very, very simple product of which are known as MLD, market linked debentures. Primarily, you will find it is more of a quasi-debt or more of an NCD kind of product with a some kicker of equity linked to it. But there are many innovative products could be created if proper technology being used. That's what we experience globally.
Right. Great. I think we'll bring this session to a close. Thank you so much for your time, Sandeep and Alok, for taking us through this journey. I think it's abundantly clear that FinIQ is here to play a role more as a knowledge partner than purely as a technology provider. And we look forward to connecting with members of this forum moving forward. We'll bring this to a close. Thank you very much.
Thank you.